Okay, so you know what? Let's start. Yeah, I know there's quite a bit to go through. A lot in terms of even revision. So for today, we do have quite a bit to cover. So we'll probably have to start now. But don't worry, on our last lecture, we will have some time. So the last lecture is not too heavy. So we will have some time to do some revision if you require, you have some questions. If you do have some queries, we can go through them on the last lecture. So this lecture a bit heavy, but this it's got last heavy lecture, right? So hanging there. I know some of you say it's a bit tough, right? Yeah, especially if you are coming from other management faculties like supply chain, HR. This might be a bit mathematical. Yeah, hang in there. We're almost done. We're almost done with the course. Okay. All right. So let's start. So today is our second last lecture. We will be covering two key parts of the lecture, and it brings in all the concept that you have covered that we'll be covering from lecture 1, 2, 3, and 4. Right. So we are bringing all the concepts that we know into this last lecture, lecture 5, or not last lecture, second last lecture. And so it's quite important that hopefully you can still recall some of the knowledge that we covered in lecture 1, in lecture 2, 3, and 4 for all this last lecture, right? Okay, so let's, as usual, let's broad overview first of what we're going to cover today before we go into all the nitty-gritty details, right? So in terms of the broad overview, right, recall at the start of lecture 1, we talk about this formula called CFA, right, where it's the cash flow from assets. Hopefully you recall that formula because this formula is super important for today's lecture, right? So recall lecture 1, we did this particular formula to calculate the cash flow from assets. We're going to use it today. And then we move on to talk about like time value of money. We're going to use the concept of time value of money here. And then we move on to weighted average cost of capital, right? We did the calculation for cost of debt, cost of equity. We did the SML line. I hope you still remember what's that. And then we did the weighted average cost of capital. And so with this information or with this knowledge, right, now what we're going to do in the final step is, first of all, we want to predict the type of cash flows, right? And eventually use the prediction of this cash flow to make certain investment decisions, right? So we want to see, okay, should we invest in this project, or should we not invest in it because it's losing money, right? So we need to, first of all, predict the cash flows, and then we use certain decision rules to determine whether we invest in projects or not. And so today's lecture, we are going to come out with the cash flows, and we're going to learn all the various decision rules that we can use to determine whether we should accept or reject certain investments. And the thing is, these kind of questions can be quite big, even in your final exam, where we need a discount rate, right? The discount rate, I hope you can still recall, is what we calculated in our WACC. Right, so we need WACC, we need to do discounting, which is lecture 2, and we need to use the CFFA formula, which is covered in lecture 1. Okay, so for the CFFA formula, that's a good question. The interest, depending on the question, right? So for tax, right, tax is tax rate. So for CFFA formula, for interest, you need to see what the question gives you. If the question gives you interest rate, then you need to multiply by the long-term loan to get the interest amount. Yes, that's required in the formula. So look at what the question gives you. That's a great question. Thanks. Okay, so let's without further ado, let's start. First, we're going to cover the decision rules, right? So there are a few decision rules that we're going to learn to determine whether a investment should be it's a positive investment or not so good investment, right? Okay, so when we talk about investment, what we're actually referring to is this idea called capital budgeting, right? Capital means what? Capital is like money, right? Capital means money. So what we're going to try and do here is we're trying to budget for the kind of capital that we're going to invest in. Budget because capital investments are usually very big. It costs multi-million dollars. So even before we decide, yes, we're going to invest in this, we need to determine, okay, is this a good project to go to, right? Or if it's not good, then we reject it, right? That's why we need to do all this forecasting of cash flow. We need to learn all the various techniques to determine whether a project is good or not. Okay, so this is used to analyze potential projects. These are used to make long-term decisions because generally the expenditure of expenses is very large. So you cannot just say, I want to do a project tomorrow, right? You need to make sure you do enough forecasting to determine whether it's a good or worthwhile project to do. Okay, it's difficult to reverse. And generally, what we're trying to forecast or what type of projects we're trying to forecast are things including the replacement, expansion, whether it's a new product or certain projects, right? Specific projects such as safety, environmental kind of projects, right? This is just a broad overview, so we're just going to be faster on this point, right? Right. So a good investment decision would require a few things, right? So a good decision criteria require a few things that we have learned throughout the course so far, right? It has to consider things like how much do you invest at the start? What is the money that you spend, right? In simple terms, what money do you spend at the start? It has to consider the various operational cash flow, meaning the cash flow you receive once you implement the project, right? You receive some money that's coming in, so you need to consider how much will you receive, right? You need to consider certain things like working capital, right? Quick question. Anyone recall what is the meaning of working capital? Because we're going to tackle this subject quite in detail today. But in simple terms, what is working capital? Very good. Money used for day-to-day operations. I'm glad you used that phrase because this is what we have been talking about. Yes, you are totally right. Money used for day-to-day operations. So we need to determine how much money do we need for our daily operations of this project, let's say. Last but not least, we need to determine terminal value. So what does terminal value mean? It means that, let's say, in simple terms, right? Let's say the project has ended. Do we sell the asset away? Right? If we sell the asset away, this is the is what we can recover. Sorry, no. If the FA means fixed asset is being sold away, this is the money that we can receive, right? Or is this project perpetual? Perpetual means that it goes on forever, right? And if it's perpetual, then we'll not sell off the asset. So these are things that we consider in a good decision criteria. Okay, we also need to consider time value of money as we talk about risk adjustment, meaning that we need to consider WACC, right? Are we able to rank the projects? And last but not least, how do we determine whether there is some value added by taking on that project? Okay. So those are the criteria required when we want to determine whether a project should be taken or not taken, right? So the first decision tools, I'll say decision tools that we're going to use is this thing called NPV, right? So net present value. So we're going to use this tool called net present value to determine whether the project is worth taking or not. And this net present value, hopefully, it's a bit more intuitive, right? The idea of it is that, in simple terms, is that we have cash flows coming in from the project, right? So the idea is if we discount all the cash flows, future cash flows, we discount it to the present, right? And then we take the present value of the cash flows, compare it with the initial investment amount, the initial cash outflow in order to start the project. Remember the initial cost required. If we take these two costs and less them off, if we have a positive value, means that it's going to add value to our company, right? So take the initial cash outflow and then you less off all the cash inflow, which is the summation of all the cash inflow here, and then we determine whether it's a positive or negative. right? And important thing is that we use the WACC here. Okay. So if it's a positive, means what? We will accept the project. Why? Because it means that the cash inflow coming in, the present value of this cash inflow is more than the initial cost of doing the project, right? It's more than initial cost, meaning that it adds value to your company, right? So more than zero means that it adds value to the firm, increase the wealth of owner, right? So any MPV that is positive increases the shareholder wealth because the cash inflow is more than the initial cash outlay when you want to start the project. Okay. So an NPV of zero means that the project inflow exactly offset or repay the initial invested capital or cash outflow. So if you want to use this concept of NPV, the decision rule is that any NPV that is more than zero, we will accept because it creates value. Okay, this is the decision rule for using the NPV method. So this is a bit more, there's some elaboration. So the NPV method consider all cash flow, consider time value of money, uses the WACC, which is risk adjusted. We are able to rank mutually exclusive projects. We will talk about this in just a few slides. And indicates whether value is added to the firm, right? Where positive NPV means that value is added. So this is the most important part. Whenever we have different decisions, later you'll see there's a few methods that we'll use or we'll be teaching. Whenever there is some big variance in terms of decision, we always fall back on the NPV. So NPV is the most important method. Okay. So I mentioned what does mutually exclusive project mean? So mutually exclusive project means that you can only accept one project, and by accepting this one project, you cannot accept the other project, right? They are mutually exclusive. Another term that you will see in questions is independent projects. It means that the cash flow of one project is unaffected by the other projects, independent of each other, right? So you'll see these two terms as we go along today's lecture, and they are important to differentiate. So in a situation where you have several mutually exclusive projects and all of them have positive NPV, which project should you choose? The answer is there, but maybe you can say which project should you choose and why. So you have multiple projects, all with positive NPV. The question is, which project should you choose? Okay, I see yes, highest. I see somebody say that you should choose because it gives you the most amount of money, makes your shareholder the most wealthy. That's right. So you're following the concept of it, right? Highest means that you can make most cash inflow. You're totally correct. Perfect. That's great. Okay, so we do have a question here. I'll hop over to Excel to show you how to do it as well. So let's look at this company, right? It has a major expansion of its product line. It estimates that the following cash flow associated with the expansion. There's an initial cash outlay of this amount. The project would generate a cash flow of 450K per year for 6 years. And the appropriate discount rate is 9%, right? So quite good. They will tell you what is your WACC. So you don't need to do the calculation for WACC, like what we normally do. Okay. And then the thing is, calculate the net present value. Okay. So I hope you have Excel with you. And please follow me on this example here. Let me share my screen for Excel. So see, now I'm just going to okay. So let's see. Looks like sorry, can you see my Excel screen or no? Now, okay? Okay, okay. So let's see this question, right? Um, we do have a cash outflow. Let's start off with the years. So hopefully you can follow me on this example. I'll just show it once. Okay, so you have the years, you have the cash flows, as you can see here. In terms of years, we start with 0, 1, 2, 3, 4, 5, 6. We have 6 years. Initially, we have a cash outflow of negative 950. 1, 2, 3, and then after that we will get some cash inflows. Okay, and then we have some cash inflows coming in as well. Let's just put all this here. Okay, let's just make this a little nicer with this. Okay, so we have this here, right? So this is not a new formula. We actually use this MPV formula in lecture 2. So, if you need a recap on this, feel free to watch lecture 2's recording. But this is just a very fast recap, right? So let's just pull out our MPV formula at MPV. Okay, we pull out MPV here. And recall, the most important part about using MPV formula is that you do not include the first cash flow, meaning the cash flow at year 0. Okay, let's put our rate first, 0.09. Remember, rate is always in decimal. Okay, now, and then we do this. So I'm just going to pause here for a short while. And I want to repeat again, for our MPV formulas, we do not use or we do not put in the cash flow at year 0. So you only start with cash flow at year 1 to the end. And we put the cash flow at year 0 outside the MPV formula here. Okay. Any questions on this? So this is the most important part about using MPV formula. If not, your answers will be wrong. Everyone good? No questions? Okay, I guess you are giving it a try as well. Okay, so if you click enter, you should get this, right? So it's exactly what you see in your slides as well. So you get 68, around 68K. So a question to all of you, based on 68K, should you accept or reject this project? Accept? Perfect. That's right. We accept the project. Okay. Um, all right, I stop sharing. So I hope everyone could get the MPV formula. So just repeat one last time. Your MPV formula, you must not include the cash flow at year zero. The MPV formula starts with year one's cash flow, and the year zero cash flow has to be placed outside the formula, as you can see here. They accept the project because it provides cash inflow for your shareholders. Okay, so we do have some example here. Another example, maybe I'll just share my screen one more time since it's the first few times we are doing it using the MPV. Okay. Okay, so you should be able to see my screen now. Let me just input the year. Let me know if you can't see my screen, let me know. If not, guess it's good. So let's put in the cash flows, as you can see here. Okay, we have two sets of cash flow, the faster system and the slower system. Slower system is negative 700, 300, 300, 300, right? And in both cases, I'm going to use the MPV formula as well. With the MPV, same concept, plus the cash flow at year zero will be outside. Oh, I forgot to put the rate. So the rate given is 0.07. There we go. Okay. I'll just hover over this formula here just for you to have a look on what I have inputted in my Excel. Okay, so based on the MPV of the slower and faster system, which system should you choose? The faster system. You're right, because the MPV is bigger. Okay, you're right. So that's right. Okay. So that's all for MPV. We'll use MPV more in our second part of the lecture, but now we're just teaching you all the various methods, right? So MPV is the best method, is the predominant method that you should use. Besides MPV, we have this thing called the payback period. So what's the payback period? So payback period basically takes the idea of, okay, you have an initial cost, right? There's initial cost of doing the project. Now, how long does it take for the project to be paid off by the cash inflow from the project, right? So how long does it take to be paid off? So let's um it, it estimates the cash flow and then takes the future cash flow to subtract the initial cost until you finally recover the initial investment. So it is a break-even type of measure. The decision rule is that if the payback period is less than certain preset limit, we will accept the project. Okay, let's have a look at what does this mean here. Okay, the same example, exactly the same. And they tell you the discount rate is 9%. Now, calculate the payback period. So the payback period, because all our cash flows are 450K, it's quite simple for this case, right? So let's take 1950K divided by 450, and this should give you 4.33 years. So it takes 4.33 years for all the cash inflow to pay back the initial investment. Now, the decision rule for payback period is we need to compare this 4.33 to a preset number of years. right? So in this case, assume that the firm requires all projects to be recovered within 4 years. Now, the question is, based on your payback of 4.33, should you accept this project? No, that's right, because your payback is longer. Yes, you're right, because it's beyond the 4 years. You're right. So you should not accept the project because it is beyond the 4 years. You're right. Do not accept the project. Okay. So we do have some other questions here. For this, maybe it's quite easy to see. We can see that for project A, the payback is in year two because you just subtract. In project B, payback is in year two. Project C, the payback is also in year two. So everything pays back in year two. And the company can accept all projects that is paying back in year two or less. So the question now is, let's find out what is the NPV. So I'm not going to use Excel now. I'm just going to write out the NPV that I've calculated in Excel. I really encourage you to try in Excel to see whether you can get the same answer. Right? So the first NPV is 742. Oh, sorry, not 742. 7249 for project A, project B, negative 264, and project C, your NPV is negative 347, right? So based on the NPV itself, which project should you accept now? Project A. Yeah, you're right. So I hope you can see that why I mentioned NPV is the dominant method. So when now that we have no two methods, the payback and NPV, we see that at the end of the day, we do use NPV to determine whether we should accept or reject the project, even though we have learned the payback period. But it seems in this case, everyone pays back in year two. So we can't determine the payback based on that. Okay, some advantages of the payback, disadvantages. So advantage is easy to understand. As you can see, quite intuitive. It's like, okay, what's the initial cost? How much time does it take to pay back? Quite intuitive. There's this bias towards liquidity. What does this mean? It means that if you get the money faster, right? So I'm just going to flip back to this example here. Can you see that, let's say, right, for project C, you only get back this in year three here, right? 2000 year three. So the payback count would direct you to take on project A and B, which gives you money in year one and two, right? So it is biased towards liquidity. So it encourages you to take project that is positive for liquidity, right? It means you get money faster. Okay? Biased towards liquidity. The disadvantage, I hope you can spot this, is that we, throughout using the payback period, we did not use any discounting or compounding, right? And recall that at the start of the lecture, we mentioned that discounting, compounding is the most important concept in finance. With everything when you do, we need to compound or discount. We cannot just say, oh, there's non-compounding, like in this example of payback, right? It requires a arbitrary cut-off point, which is determined by a company, let's say in the last example, 2 years or less, right? They say 2 years or less. There's no way to say, oh, why can't it be 2.1 year or 2.2 year, right? It's arbitrary. It ignores the cash flow beyond the cut-off. Let's say, in this example, can we see in project A, there is a large cash flow happening in year three, right, in project A. However, we totally ignore it. We don't even consider it in our payback calculation, right? So it's not so good in that sense. It's biased against long-term projects. So why is it biased against? It means that, let's say in project A, we see that there's a $10,000 cash that's coming in year 3. And this can be like research and development, so it takes a while for it to generate money for you, right? So it is biased against project A, which gives you money much later and large sum of money. Yes. So you're right. So there might be some example or some cases where the company needs money within the first 2 years. So having a cut-off um, payback period of 2 years would allow the company to choose a project that makes sense because they need the money within 2 years. You're right. So there can be a case like this, right? That's a good question. So no, that's all for payback. So we see that there's some negative for payback, some positive for payback. Now, the method 3 that we're going to learn, number 3, is this thing called internal rate of return. And this is IRR, right? This thing called IRR. And this is the second most important method that we're going to learn. And we're going to cover a lot of details on IRR. And you'll see why. So it's the most important alternative to NPV, widely used in the industry, it's intuitive, it's based on estimated cash flow, and independent of interest rates. Okay, let's see what does it mean, and so we can understand the few points that we talked about earlier. So the internal rate of return, IRR, is calculated by making the NPV equals to 0. So we have the cash flows here. Recall we have some cash flows, the initial cash outlay, we get some cash inflows, and we want to determine this rate. So we are trying to determine the rate that makes the NPV equals to 0. So that's the purpose of IRR. We want a rate that makes NPV equals to 0. And the question, what does NPV equals to 0 means? So anyone, yes, as in the total, yeah. So the NPV, total NPV equals 0. Yes, I saw your answer. It means that you do not earn, you do not lose. You break even, right? The project has no worth in investing. There's no return. Exactly like break even. Exactly 0, right? Correct. So we want to determine the IRR that, or this rate, the rate here, where the NPV equals to 0. So you just break even perfectly, right? And the thing is, you want to accept project if IRR is greater than the required rate of return. So what does it mean? It means that let's say your required rate of return, which is your WACC of the company, is 10%, right? You require 10%. Now, if your project is going to give you 11%, it means what? You are going to earn more than your required return, right? It means that you should accept the project, right? So you accept any project that has an IRR more than your required rate of return. So that's the decision rule here. Which makes sense, right? Because the IRR is the break-even point. So anything more than your IRR means that you should accept it. So just a comparison between NPV and IRR. NPV is the net present value. So we calculate, we know that a WACC, then we discount all the cash flows to give you a final summation of cash flows. And this is your NPV, right? Now, IRR, on the other hand, is almost the same. We are doing an NPV method, but we want to determine this value here that will make our NPV equals to 0. So we determine what is the discount rate that will make our NPV equals to 0. So that is a slight difference. Okay. So we do have the same question again. Not going to repeat this question, but we have an initial cash outlay. We have some money coming in for 6 years. And the question is, determine what is the IRR. So in the IRR case, we simply use the IRR formula in Excel. But the important thing to take note is that we include all cash flows, even cash flow at year zero. And then we click enter to give you the IRR here. Okay, so I repeat, for MPV, we excluded year zero. Now, for IRR, we include all cash flows, including year zero. Yes, correct. So you are right. That's the correct understanding in layman terms. So IRR is like a break even. So if your IRR is less than your required rate of return for the company, which is your WACC that we have learned last lecture, it means that you should not invest in the project because it wouldn't give us much value. You're right. So we need an IRR that is more than the WACC. Okay, so in this case, you have calculated your IRR at 10.17. And so the thing is, the appropriate discount rate is 9%, right? So if your IRR is 10.17%, it means that this is more than your required rate of return. And the question is, should you accept this project based on IRR? Yes, yeah, right. Accept the project based on IRR because it's more than your required rate of return. So IRR has quite a few advantages. It is, preferred by executive, it's quite intuitive. IRR that is large enough means that we do not need to estimate the required rate of return. What does this mean? It means that if the required rate of return is 10%, your IRR is 11%, very close to your required rate of return, then you can just use IRR. You don't even need to try to formulate a required rate of return. It considers all cash flow, it considers time value of money, it provides some indication of risk. Now, what's interesting is the disadvantages of IRR. Okay, so let's try to understand this, right? There are three main disadvantages of IRR. It can produce multiple answers. Okay, it can not rank mutually exclusive project. Question, a small recap. What does mutually exclusive project means? Yeah, you can only do one. That's right. So if you have two projects to compare and you use IRR, it's going to give you wrong answers. Now, it has a reinvestment assumption flaws. Okay, so there are three disadvantages, and we'll go in detail what they are. Okay. Yes. Okay, so I saw you have two questions. Can you explain the first part about multiple answers? Yes. So we'll go actually in detail for we'll spend a lot of time explaining the multiple answers, etc. So we'll go in very detail. So don't worry. Yeah. So those is just a brief, right? So the generally MPV and IRR will give you the same answer, but there are some issues with things like mutually exclusive projects. This is the multiple answers, which we'll talk about in detail. Multiple answers, okay? And there's this reinvestment issue here. Okay, we'll talk about it in detail, so do not worry. Okay, so the first issue that we talk about, multiple answers, right? Let's think about this example of a non-conventional cash flow. Okay, so what does a conventional cash flow mean? So a conventional cash flow means that you start off with a negative value, means a cash outlay, and then all subsequent cash flows are positive. Okay, I repeat again, a conventional cash flow, it means that you have a negative cash flow at the start, and all subsequent cash flows are positive after that. So it's a conventional. Now, in this case, we have a bit of non-conventional. So initially, we have an initial cost of 90K. And then in year one, you're going to get some money, positive value. You get some positive value in year two. And then in year three, you have to suddenly pay something, right? You have to pay 150K. In this case, with a requirement of 15%, because of this non-conventional cash flow, it's going to do something very strange to your IRR. So let's have a look here. Okay, so if you're going to put this in Excel, and we're just going to put IRR, this chunk of figure here, put IRR, it's going to give us this IRR of 10.1%. Okay, I hope you can try this now as we talk about it, right, on your Excel. It's going to give 10.1%. Now, in the IRR formula, you can see this function called guess, right? So I have my Excel with me. I hope you can follow. IRR, and you're supposed to put a value, and then there's this bracket called guess. Can everyone see it in your Excel? Yes? Okay. Okay, you can't see my Excel. That's right. Okay. Now you can see it, but on your own Excel. Yeah, but you can see my Excel as well. Now you can see it, right? Can you see the guess function? Yes. Okay, the guess function here. Okay. Now, the thing is, if you put guess and you put 50%, your Excel is going to guess the other IRR that you cannot see in your initial calculation. So I'm just going to stop sharing. Okay. So it's going to guess this, it's going to guess the second IRR here, which you cannot find if you just use IRR. Right? And so this is where your guess function comes in. I hope you do remember in your lecture 2, we did mention a bit about this guess function. So now you really are going to use this guess function. And this issue, the IRR, only happens when you have a non-conventional cash flow, meaning that you have a negative cash flow at the start, positive cash flow, and then again you got negative cash flow later. It only happens when you have this case. Okay, and the thing is, there is two IRR now. So the question is, should we accept or should we reject this project? It's very confusing, right? If your required rate of 15%. So let's plot this IRR curve here. Okay, with the guess function, we have received a IRR of 10.1% here. Okay, now I see a question, why guess at 50%? So the thing is, you can guess about any percentage, right? You can guess 20%, you can guess 30%, you can try your Excel now, guess 20%, guess 30%. You should still get this second IRR of 42.7%. So the idea of the guess function, which we talk about it a little, I will kind of explain what it means in lecture 2, is the idea that you're trying to ask Excel, can you see whether there's a different answer other than 10.1%. And so the guess function should be close to the second answer. Of course, you don't know what's the second answer, right? That's why you try to guess. Why I know it's 50%? Because I know that second IRR is 42.7. Of course, you don't know that, means that you need to try to guess, right? So if you don't know that, you need to guess 20%, guess 30%, guess 40%, right? Until you get a second answer. And in this case, you get a second answer of 42.7%. That's a good question. Why guess 50? So you do not know. It's a really guessing. You're trying to guess. Okay. And so if you guess at 50 or guess at 40, you should be able to get the second IRR of 42.7 here. And so once you get these two IRR here, and recall again, why does this graph make sense? Because IRR is the discount rate that makes NPV equals to 0. So right, can you see this? The y-axis NPV, the x-axis is the discount rate. So it is the discount rate where the graph is the x-axis, right? Where NPV is 0 here. So we have two discount rates. And the thing is, we based on the NPV profile, we see that any NPV that's here is negative, any NPV that's here is negative, right? These are all negative figures here. Here is all negative, means that anything that is here is a positive NPV, and it means that we should accept the project because this area here is a positive value. So the rule of time, a rule of thumb, a project typically has more than one IRR if the cash flow stream changes sign more than once. It means what? It means that it has a negative at the start, it becomes a positive, and then it becomes a negative again, right? So it changes the sign more than once. And in this case, we will have a multiple IRR issue, which is one of the issues with using IRR. Any questions on this first issue that we will face for IRR? Yes. So for NPV rule, if NPV is negative, means you reject, right? Because it means that it destroys value, right? NPV negative means you reject. So I see a question, but I would need to try 40% for example. Yes, you can try 40%, you can try 60%. The thing is, this guess function basically tells Excel that you expect a second number, a second value, and you want Excel to guess a value that is close to the guess amount input. So you have 40%, you should still get the second answer of 42. Yes, so you need to calculate both IRR, one with gas, one without gas. If you see an issue of cash flow changing side, right? So if it's a conventional cash flow, you do not need to do the gas function. Now, if you notice that it is a non-conventional cash flow, you will need to do the gas function. Yes, you can guess any percentage. Yeah, you can guess any percentage. You can guess 40%, guess 30%. Basically, what Excel is doing is that because there's this one which is 10.1%, and then it's one 42.7, let's say 42.7%, right? So you want Excel to try to estimate this value here. So you can put, let's say, 30% for the guess function. You can put, let's say, 55%. So Excel will try to guess this value until it gets this. Guess. So that's how Excel will try to guess the value. How do you make you go by 10? So usually I go by percentage. So let's say your first value is 10%. Let's try the guess function of 20%, guess function of 30%, 40%. So use whole numbers, right? Don't use 1, 2, 3, 4 like that. Just go by 10%. Yes. Okay. So that's a good question. So for the guess function, you only, okay, I'll repeat again, you only use this when you have non-conventional cash flow. So if you have conventional cash flow, forget about the guess function. Don't even need to guess it, right? There's only going to be one IRR. Now, you have non-conventional cash flow. Yes, you need to guess. And the thing is, there could be 3 or 4 IRR. So the idea, right, is that so let's just erase this, right? So the idea of why there might be multiple IRR is because it goes back to your concept of mathematics. That's a good question. So it goes back to mathematics, right? And what does this mean? So let me just, I'm erasing this. Okay, let me show you. So when the cash flow change, the cash flow sign change more than once. So then the sign change twice, negative, positive, negative, you will get a quadratic function. And a quadratic function cuts the x-axis at 2 points. That's why you have two IRR. Now, if the sign change uh, negative, positive, negative, positive, so like this, it will give you a quadratic, no, sorry, a cubic function. A cubic function cuts the x-axis 3 times. So you get 3 IRR. And then it goes on, right? After that, you have yeah, you cut the x-axis 4 times, 5 times. So it can keep on going. But of course, do not worry. In the exam, they will never ask you to do a cubic function like this. They will never ask you to do this. The most they ask you to do is a quadratic function, which means they get 2 IRRs. Yes, correct. So it is within. And why is it within? Is because of when we plot the IRR, this portion here, sorry, this portion here is the positive NPV. And so this positive NPV means that is if the discount rate is within this part here and here, we should accept. Yeah. So do not only use the gas IRR, you even need to use both IRR to compare with the required rate of return. Will they ask you what is the NPV? Why not? Right? They can ask you what's the NPV, but remember, in order to determine what is the NPV, they need to tell you what is the required rate of return, right? So let's say they say the required rate of return is 0.3, then you can use the normal NPV method to calculate your NPV, right? With your required rate of return, you can calculate what is your NPV. And so you can determine that the value of your NPV is somewhere here, around 2K, right? Around 2K, something like that. You can actually calculate that, your NPV. Those are very good questions. Now, shall we move on to the second issue of IRR? Okay. So the second issue of IRR is that cannot rank mutually exclusive project. It cannot. Okay. And we know that mutually exclusive project means that you only can accept one project and you cannot accept the other one, right? And why doesn't it rank them well? It's because when the two projects have substantially different initial investment and the timing of the cash flows coming in, the positive cash flows coming in is different, your IRR is going to give you the wrong answer. And we have an example to show you why. Okay, let's look at these two projects here. Project A. Project A, initial investment, negative 500. Project B, initial investment, lesser, negative 400. Now, for project A, we get a cash inflow of 325, okay? But in project B, can you see that you get more cash flow at the start, but less cash flow at the end? So there is some difference in terms of the timing of cash flows that you get. Okay, we calculate the IRR for project A, we get 19.43. We calculate project B IRR 22.17. So we know that by comparing both projects, you should accept the project with the higher IRR, which is 22.17. So based on the IRR rules, we will accept project B. Now, a second part, let's say we calculate the NPV now. Okay. Say the required rate is 10%. We are given that the required rate is 10%, we can calculate the NPV, project A and project B. And we see that based on this NPV, we should accept the project with the highest NPV, which is project A. So you select project A. So now there's some issue already. So the question is, which one should you use, IRR or NPV? So which decision should you use, IRR or NPV? NPV, you're right. Now, you're right, because NPV is the predominant method. It's always the one that's correct. But the question is, why does it give different answer? That's the more important part that we need to try to understand. Okay, and so let's try to understand what's happening here. For mutually exclusive project, because it's two projects, if we're going to plot the NPV versus discount rate, we see that project A has a profile like this, the dotted line, and project B is the non-dotted line, right? And the thing is, if your discount rate, and then there's this part that cuts, that the profile, the two lines cuts each other, right? And the thing is, if the discount rate in the question is 10%, 10% is somewhere here, right? 10% is here. So based on the 10%, which NPV profile is higher? Profile meaning which line, which graph has a higher value, A or B, based on discount rate of 10%. A, right? I hope everyone can see the dotted line is higher than the solid line. So in a discount rate of 10, we should accept project A. No. But what's IRR? IRR means that what is the value of the, what is the required return that when NPV equals to 0. So the IRR is the point on the graph that cuts the x-axis. So in project A, it cuts the x-axis at here, which is 19.43, and it cuts the x-axis for project B at 22.17. And so if the discount rate is here, which is below the crossover point, there is going to be a conflict between the IRR, which is the point where the graph cuts the x-axis, and the NPV. So I repeat again that point. If the discount rate is less than the crossover point, there will be a variance, or there will be a difference between the IRR given by the point where the graph cuts the x-axis and the result given by NPV. So let's, as an example, at 10%, the graph say take project A, right? Take project A. But IRR says take project B. Now, if the discount rate is more than the crossover point, the NPV says take project B because the graph is higher, take project B, and IRR also says take project B. So depending on the discount rate, you're going to get different answers for your mutually exclusive projects. So in a situation where you're faced with a mutually exclusive project, I think your question you want to ask is, how do you determine this crossover point? How do you determine this, right? To know where your discount rate is. Is it below your crossover point, or is it above your crossover point? And so you want to know whether you get different answers for NPV versus IRR. And so how do you determine the crossover point? I have provided you the working here. You have two projects A and B. What you do is you just take project A cash flow minus project B cash flow. as seen here. So this is the cash flow of project A minus project B. And after that, you just type IRR and it will give you 11.8%, which is the IRR of the crossover point. I'll pause for a short while. Any questions? So the last part that I mentioned is the question you want to ask is that no worries. Okay, no worries. Okay, so the last part is the question you want to ask yourself is how do you determine crossover point? Right? Crossover point seems like a crossover point is important because if your discount rate is here, you're going to have conflict between your IRR and MPV. Now, if your discount rate is here, you are not going to have any conflict, right? So, question now you want to ask yourself, where, how do you determine the crossover point? And it's not very difficult to determine a crossover point. And they can actually ask you this in your assessment as well, right? How do you determine the crossover point? You simply take the cash flow from project A minus the cash flow from project B to give you the difference in cash flow. You do it for the period 0, period 1, period 2, and then you calculate what's the IRR here. And this should give you 11.8, which is the value of the crossover point. All right. So this is a graph, but then let's try to understand it in what does it mean, right? Why does the graph cross each other? This is quite interesting, right? So let's try to use some qualitative explanation. So when there's different size of the project, we call that project um, A is larger, right? Negative 500 initial investment. Project B is smaller. When you have different size in project, the smaller project frees up the funds faster. It means that if the opportunity cost, which is determined by the discount rate, right? If the opportunity cost or the discount rate is high, the more valuable project, sorry, the high opportunity cost, the more valuable these funds are. So the higher discount rate favors a small project because the extra funds can be reinvested at a higher opportunity cost. Right? So since project B has a lower initial investment, the higher it has higher NPV after the crossover point where it has higher discount rate because the higher discount rate means there's high opportunity cost. So it will favor, if the discount rate is high, it will favor a small project which requires less investments. In terms of the timing difference, so that's the first explanation of why the profile cross each other. The second one is the timing of the cash flow, right? So recall that for project B, the cash flow is lesser in year 2, right? So a project that has a faster payoff period provides more cash flow in the early years of reinvestment, right? So if the discount rate is high, there's a faster payback period, which allows more cash flow to be reinvested at a higher rate. So let's try to determine the payback period for project B is 1.375. For project A is 1.54. Right? So based on the payback, we see that project B pays back faster compared to project A. So a higher discount rate means that for project B is preferred because this amount can be reinvested. There's higher opportunity cost, right? Because if higher discount rate means higher opportunity cost, means that for project B, because it pays back faster, you can use the money to reinvest it at a higher rate. That's why there is a cross between the NPV profiles. Okay, so I think now, okay, so it can be a bit heavy. I think it's a good time to take a short break. Let's see, we have a question. Will this scenario be tested with non-conventional cash flow? Generally, no. So they will not mesh out like non-conventional with mutually exclusive, make it very complicated. No, they won't. So it's usually quite direct. If they are trying to test you non-conventional, if it's non-conventional, if it's mutually exclusive, then they'll test you mutually exclusive. Yeah. Okay. No, let's take a break. And if you do have any questions, you can answer them after the break. We will come back at 8:15. We we just take a short break. Uh, yes, I do see a question. We'll answer that in a bit. Okay. All right, welcome back. Um, just before the break, I do see a question. The question is, will non-conventional cash flow be mixed with payback period? No, generally, they will not do non-conventional cash flow with payback period. So questions are usually quite direct. They will not try to mix and match and combine the various difficulties. Of course, you do need to read the question very carefully. Okay, there is a direct message to me, and the question relates to what happened if there is some changes in terms of the cash flows as you're doing the projections. So if you notice, right, in the first part of our lecture on what we've covered so far, we are really focusing on the type of method to test whether we should accept or reject the project, right? We have not covered the part of actually coming out with the cash flows. If you notice, we in all the examples, the cash flows are given to you. So in a real life situation, we will have, or actually in the second part of the lecture, we will learn how to calculate the cash flows. How do we get the values of the cash flows? And so in a real life situation, when there are changes to the market conditions, right, we will need to adjust our cash flow projections, which will affect our final decision. Okay, so in that question, there was just asked was a private message. It was talking a bit on, let's say there's a changes in GST, or maybe something happened during the project. Maybe a supplier cannot um supply you certain goods you need to buy from someone else. These will cause a change in the cash flow. So yes, all these factors that affect the cash flow will impact your cash flow projections, and it might impact your final decision as well. So in the second part of the lecture, where we talk about how we do cash flow projections, that's where we need to consider all these factors. Alright. So hope I answered that question. All right, so moving on to the third issue that we talk about. Remember, there were three issues with the IRR. The third issue is this thing called reinvestment rate assumption. So the reinvestment rate assumption for IRR is assuming that we are going to reinvest any amount of money for the project at the IRR rate. What does this mean? It means that, let's say we calculate IRR of the project at 30%. It means that any cash flow in between will be reinvested at 30% rate. And this might not make much sense, because can you actually get 30% out of your intermediate cash flows? You might not be able to do that. So this reinvestment rate assumption actually is very flawed, because we know that the IRR and the WACC can be quite different. Your IRR can be, let's say, 30%, but your WACC, which is your weighted average cost of capital, can be, let's say, 15%, right? So it's half of it. So the thing is, in real life, if you take the money out, you cannot receive 30% of IRR. And it is the assumption used in IRR, right? So the thing is, as compared to NPV, because we need a discount rate and we use the WACC for NPV, because of that, your NPV, it's more realistic, because the NPV uses WACC, which makes more sense, right? So because of this, we should always focus on using the NPV. It's more realistic, it's a better method. Okay, so the last part is, if there is any conflict between IRR and NPV, NPV is the predominant method. It's not IRR is not reliable for non-conventional cash flow. as it's not reliable for mutually exclusive cash flow. So we have an example here. Let's say we have two projects, project A, project B. We can immediately see there's might be some issue because the timing of cash flow is a bit different. Okay, now you can try this in Excel, but in Excel, we can find what's the IRR for A. Project A IRR is 22.2, project B IRR is 21%. Question, based on IRR, which project should you choose? Project A, that's right, because IRR is higher, right? Now, if you do the NPV based on the required rate of return of 11%, you receive an NPV of 14K for project A and 16K for project B. So question, which project should you accept now? Project B. And in this sense, we know that it's a mutually exclusive project, means that it's going to face the issue of the IRR issue. So we always must use NPV to determine which project you should choose. Okay, so this is the example. Now, on our last point about the reinvestment issue, remember the reinvestment rate issue, there is a solution for it. And this is what we call MIRR. So the idea of MIRR is that I'm going to tweak and allow the IRR formula to on a discount rate that I determine, right, that I want to use. So instead of forcing the IRR formula to reinvest the cash flow at IRR rate, I'm going to use this modified version of IRR, which will allow the formula to use a discount rate that I can determine. And so because of that, your reinvestment is going to be at your rate that you determine. So you control the last issue of the IRR, which is the reinvestment rate issue. And the MIRR is going to tackle some of these non-conventional cash flow as well, right? And we'll see three methods to use MIRR. Before we go into all these detail here, I want to highlight the important thing about these three methods. All three methods gives you different answer of your MIRR. Okay, all three methods are correct. So if a question tests you on this MIRR, please read the question carefully, see which method they want you to use, because all three methods are going to give you different answers. They will vary in a little bit. We'll see the three methods. You'll see there's a slight variance because they are using different ideas, right? The first method is called the discount method. Okay, discounting method. So what's the discounting method? You're going to discount future outflows, important only outflows to the present, and you add it back to your cash flow zero, which is your outflow cash flow. This method helps to solve the issue of non-conventional cash flow, since any outflows after cash flow zero will be discounted back to cash flow zero. This means that there will only be one IRR, right? Because everything is just going to be discounted. Okay, so before we look at method 2 and method 3, let's look at the example here. Okay, so I'll cover this slide in a bit, but let's look at example. What does it mean by the discounting method? So we do have this cash flow here, and we see that there is a non-conventional cash flow because we have a negative at year 5 and negative in year 1. Sorry, year 0. Year 0 is fine, right? But you have a negative in year 5. We know that the interest rate is 10%. Here, let's do the MIRR using the discounting method. So discounting method says that we need to discount all negative outflows or negative cash flows back to year 0. And so we know that in year 5 there is a negative So we're going to discount this value back to year zero as shown here, right? So in year zero, our total cash outflow will now be the cash outflow at year zero plus the cash outflow in year five, discounted by 5 years. Now, having done that, the cash flows now, as I show you here, quite beautiful, right? Everything is positive after year zero, right? Year zero is negative, everything after that is all positive. So we have now avoided the non-conventional cash flows issue, and by just using the IRR formula here, normal IRR formula in Excel, we can get the MIRR based on discounting approach. Okay, first method. Now let's go back to method two. Method two of calculating MIRR, and I repeat again, all three methods are going to give you different answers. The method two is called the reinvestment approach. What does this mean? It means that we're going to compound all cash flows, whether it's in or out, so whether inflow or outflow, except the first cash flow at the reinvestment rate. Means what? So after the first cash flow, any other cash flow after that, I'm going to compound it to the end. And this actually tackles the issue of the reinvestment rate. Remember, for IRR, the issue is always the reinvestment rate at IRR rate, right? But we don't want that because we know that if IRR is 30%, are we sure that we can actually earn 30% on our intermediate cash flow? No, we cannot. That's why we want to use a discount rate to compound all the cash flows to the in or out cash flows to the future, so that we only have two cash flows. So maybe you're like, okay, this sounds a bit complicated. Let's look at the same example here using the reinvestment approach. Okay, so in this example, we know that we are given all these cash flows here, right? So what do? Any cash flow that is beyond year zero. So this cash flow here, these four cash flows will be compounded to year five. So how do we compound? Okay, we just in lecture 2, we already know how to compound. We just compound everything here like this, and we add it back to the last cash flow as well, which we get this, right? So what do we get now? We only get two cash flows. We have one negative cash flow at the start and a positive cash flow in year 5. And in between, everything is zero. All these cash flows are all zero. And please be very careful. In Excel, even though it's zero from year 1 to year 4, you must put a zero there before you calculate IRR. If you don't put a zero, your answer will be wrong, right? So I repeat again, even though the intermediate cash flow might be zero from year 1 to year 4, because you have now all compounded it to year 5, you must put zero in Excel. So these are all zero. These dash are all zero. You must put zero. If not, your answer will be wrong. Okay, so once you put the zero, you calculate IRR, it gives you your MIRR of 14.9. So if you notice, this MIRR is slightly different from your discounting approach, which gives you 19.75. So they are totally different numbers for the reinvestment approach. So this reinvestment approach has avoided the issue of the reinvestment rate. Now, the last approach is the combination approach, and this generally is the best approach, which is the approach used in Excel, where you discount any outflows to the present and you compound any inflows to the end. Okay, and this is the method used in Excel. So what does this mean? Okay, so let's look at this example again. Okay, where are the outflows? Outflows are happening in year 5, right? So you're going to discount your outflows, this one, to year 0, as we see here. You're going to discount it, and you're going to compound any inflows to year 5, right? So these 4 values here is going to be compounded to year 5, as seen here. After you've done this, we have 2. Can you see you have just 2 cash flows? Outflow year 0, inflow year 5. Again, I'm going to repeat. Please put the zeros in between here when using the IRR formula. Okay, and by doing so, you put IRR, you're going to get 14.39. So the combination approach now tackles 2 issues. It has tackled the non-conventional cash flow, and it has also addressed the issue on reinvestment rate. So it's the best method. And let's say if you want to use the MIRR formula in Excel, the MIRR formula, you just simply put this chunk of value here, but you must put the discount rate that you want to discount and compound. So if you put in Excel, so you can try it on your Excel now. Type MIRR. Okay, I'm just going to show my screen so you can see what do I mean. So as you can see my screen now, I have put MIRR and you can see values, right? So the values for MIRR in your Excel, you drag all the cash flows. Okay. Now they say finance rate and reinvestment rate. So these rates are your rates that you will compound and the rates that you are going to discount, right? So you can put them as different rates, or in this question, they are the same rate of 10%. So in this sense, can you see here? Your discount, your compound and discount rates are 0.1, which is 10%, as given in this question. Okay. So the combination approach is used by your Excel method. Okay, what are the rates generally? Now it depends, right? So recall in the last lecture, we have already learned how to determine your discount rates, and this equals to your WACC, right? So depend on question. Some questions can be quite nasty, I would say, because they want you to determine WACC. Use the WACC to calculate your whatever, right? Your MPV, your MIRR, right? So it depends. Sometimes the question can be nice. They give you the discount rate, and maybe they split the question into 2 separate questions, right? Question 1, determine the WACC. Question 2 is just a separate question where they really tell you what is the discount rate, right? So it really depends on the question. But do not be surprised if the question do not give you a discount rate and wants you to calculate discount rate using the WACC formula. Mm, okay, what do you mean uh, where they are different? So what are the day? So what do you mean by day? Which rates are you talking about? The 2 rates for MIRR. Okay, so they can be different depending on the question. So this one will be based on question. So sometimes the project will say that when you compound the cash flows to the future, when you compound it, it will be rate of, let's say, 20%. But when you discount to the present, it will be 15%. So yes, there can be scenarios where they are different. Yeah, and usually it's given in the question. So maybe just explain a little more. Why will it be different, right? Let's think about it a little. So imagine yourself, right? Just in simple terms, if you get a loan from the bank is going to charge you, let's say a loan, let's say 8%. Now, if you're going to when the bank charge you 8%, this is the for the money that you put in the bank. Sorry, the loan meaning the money that you get, right? Positive to you. You take a loan, you get money. Now, if you're going to deposit the money in a fixed deposit in the bank, means it's negative to you, right? Your money is coming out from your pocket, you put in a deposit. Maybe they give you 4% return. Can you see that there's a different rate? You take a loan where the money is going into your pocket from the bank, positive to you, you're going to pay an 8% interest. Now, when you have money, you the money out of your pocket and put in a deposit account in the bank is only giving you 4%, which makes sense, right? And that's why there is a difference in discount and compound rates. Do you understand? You know, like I hope you can see that in simple terms, why is there different rates? So I think yeah, I hope so too. Okay, so now IRR versus IRR. MIRR basically corrects the reinvestment issue. It avoids the multiple IRR. Managers like internal rate of return. So MIRR is generally better as a decision rule. So MIRR is the same thing as IRR. Basically, a higher MIRR is a better um, rate. Okay. Now, the last thing we're going to look at is called PI, Profitability Index. So this one quite common as well. It measures the benefit per unit cost that has been invested. So generally it's for conventional cash flows only, conventional cash flows, where you have a, let's say, initial investment which is negative, and then you present value all your future cash flows to the present. And then you take the present value of the future cash flows divided by your initial investments to give you how much profit you actually make. So let's say you get a profit of 1.1. It means that for every $1 of investment, you will create additional 10 cents. So this is very useful for capital rationing, meaning that you have a limited amount of capital. So we have an example to show you in a bit, right? And the idea is that for any project that has a PI or more than one, means that you're going to get some money out of your investment, right? You gain more than just an initial investment. So the idea of capital rationing is when there's limited capital, the firm sometimes cannot take all the projects that it has on hand, and so it must select the project that will give the company most amount of capital. So the PI helps to find these projects, which will give the most amount of returns. So let's look at the same example here. Calculate what is the profitability index here. Okay, so the profitability index, we would need to take the NPV. Remember, is the present value of all the cash flows, right? So please use your Excel function NPV of 0.09, comma, the cash flows of 450K for 6 years, right? So in your Excel, use your NPV, drag the bar to show the 6 years. Now, once you calculate what's the NPV, you divided it by 1950123, right? And by doing so, you should get your NPV value of 1.035. And the question I have is, should you accept this project or reject this project? Based on the PI, accept? Yes, because it's more than one, means that it's going to make some money for you. So now let's look at this example. Suppose you have 100 million available for investments. You have various project A, B, C, D, E. You have various NPVs. These are your various investment requirements, and these are your PIs, right? So which project should you select, given that you only have 100 million? So the first thing you should look at is the PI, right? Because now we have a capital rationing issue because we only have 100 million, but we want to invest in as many projects as possible. So the first project we should take is the PI of 1, because the 1 is the best, right? So we must take project C. The next one is maybe project E because it's 0.48. So we take project E because it's second highest. And then the next project is either project A or project D, right? Because that is the second highest. Now, how much have we invested already? We have invested 10 million. We have invested 25 million, means we have invested 35 million. So we can still invest in project A or project D, right? But we can't invest in both project A and project D. Only can invest in one of them, right? So since we have 100 million, we can still invest in project D, right? And why we choose project D is because between project D and project A, which one has the highest NPV? D or A? D, correct. So by taking project D, we have a high NPV, and now we are taking C, D, and E. So the total NPV is this, which is 42, which is quite high, correct? So based on this, our total NPV is 42. So it's pretty good. If we take project A, we only get 15 plus 12, which is 27, a lot less. So we should select project C, D, E, which because we have A, hmm, uh, let's see, can we add up to yeah, we can actually take A, B, C, and E as well. But the PI for B is quite low. That's right. The PI for B is very low. And yes, we can, if we take A, B, C, and E, we maximize our total sum of money that we have. But if you look at the NPV, right, isn't it better to take project D instead of A and B? And then our initial investment is less as well, right? But we still get the same amount of NPV. Can you see that? Yeah, so the PI2 gives you the better answer. Yeah. But that's a good point. Yeah. So PI advantage, closely relates to NPV because we use the present value of your cash flow divided by initial investment. Consider all cash flow, consider time value of money. may lead to different incorrect kind of decision as well, especially for mutually exclusive projects. And we'll see this in a bit, why it leads to wrong um, decisions. Okay. Suppose that a firm has limited to invest 10 million today. There are three projects. Okay. They have the various cash flows and the NPVs given to you here. NPVs, we have the PI as well. This is a case of limited project as well, limited funds. So based on PI, we know that project B is the best, right? Followed by project C and project A, right? Based on PI by itself. Now, these are the cost of the project. So the question is, based on PI, we should choose which project first. We should choose B, that's right, number one. And which project should we choose second, based on PI? C, that's right, because these two are the highest. And so, based on these two, we already get a NPV. So the total for, let's just double check NPV. The total for these two projects NPV is also 27, which is more than just choosing project A alone, because it's 21. Okay, suppose we have another example here. Suppose the firm has limited to invest 50 million today. Which project should we choose? This is the same example. We do the PI, you know, based on the PI, we choose project B, then project C and project A. So it's 1, 2, and 3. So given 50 million, we should choose. Can you see that for this case, it's a little different? Because given that we only have 50 million, we know that by choosing project B, we cannot choose project C anymore, number 2, right? So we just choose, if we choose project C alone, we get a NPV of 4.7. Right? Now, we can choose both project A and B together, but if we choose project A and B together, like this, our NPV is only 4.5. So in this case, we see that project C makes the most sense. And you choose it alone. So you can see that sometimes, right, we need to be a bit flexible in terms of, okay, use this method, but let's just compare with MPV as well and try to use multiple methods to determine what makes the most sense. So there is no, like, should we prioritize MPV or PR? We need to take all the numbers together and do an assessment based on that.
Okay, hi Joe. Just wanted to check. So in this example, right? Project A had higher NPV, right? But the PI is low. But then we still choose B and C. Why?
Yes, because we can't choose B and C because we only have 50 million, right?
Oh no, sorry, I'm referring to the previous example.
Oh, previous example. This one. Okay. Sorry, your question is?
So the NPV for A is much higher than B and C, right?
Yes, that's
so
right.
why not we get A?
No. Can you see the NPV so if we choose project A, we only can choose one project, right? And the NPV is 21. Now, if we choose project B plus project C, because we have 10 million, we can take both projects. Your NPV in total is 27. So it's more than just taking project A.
Oh, okay. Yeah, thank you.
Yeah, I understand, right? So you see that sometimes it's not so static. You need to be a bit like, okay, a bit flexible. It's like, okay, yes, you have the MPV rule, and you have the PI rule. So maybe we use the PI rule first, then we compare the MPV as well, and then we make sure that we can also invest in those projects, right? We have enough money. So generally, MPV kind of always win. Is the main method that we want to use, but we can use the PI to help us direct us to the combinations that we can use, right? PI always wins at the end. Okay. Um, the last example that I have to show you here is two projects, right? And now because we only need two projects, they are mutually exclusive as well. You only choose project A or project B. Okay, so these are mutually exclusive projects. If we use the PI, recall that the disadvantage is that PI is going to give you the wrong answer. Why? Can you see that if you have two projects, right? This is not a capital rationing issue. It's not whether you have 10 million and 20 million and you only can invest in that. You can either A or B, project A or B. It's not about capital rationing. And we just look at PI. First, let's focus on PI. Based on PI, we should choose project A, right? Because it's an PI. Now, based on IRR, we should choose project A because higher IRR. Now, recall that MPV is the only method that we can use in determining mutually exclusive project because you know IRR is going to be the wrong answer, you know PI is also going to be the wrong answer, right? And so based on MPV itself, we see that project B is the one that we should choose. So in this case, always choose project B for mutually exclusive project because the MPV is the dominant method we should use. So there's some comment here since we can only choose one project because mutually exclusive, either project A or project B, PI will give us the wrong answer, right? As it does not take into account the skill of the project. Project B generates higher total value per MPV. Now there's just a small comment here. If you can choose project A twice, which you can't because it's a mutually exclusive project, you only choose one project, the total MPV actually bigger if you take two times project A. But this is not a question of capital rationing, it's not about or how many how you maximize your capital, right? It's either you choose project A or project B. Yeah. So remember project. The other example is more about capital rationing, right? When we're not saying that you can only choose project A, B, or C, right? It's more about okay, you have this sum of money. Which project should you choose? Which one should you pick and mix and match, right? So it's not really about issue of mutually exclusive, right? In this example here, the last example is mutually exclusive because we don't even care how much the initial investment amount. You can invest in both. It's just whether you want to choose A or you want to choose B. So just the final comment. MPV IRR is very common. Payback is also commonly used. All of them gives important information, but we need to know which method to pick at the end of the day. Okay. The quiz, I'll let you just review it yourself. Because I want to move on to the second part of the lecture. So there are some self-review questions. I really encourage you to go through them. They are very important because it will help you understand the concept of the different decision methods clearer. Okay. Okay. No, this second part of the lecture, I'm thinking let's take a break now so that we can complete the second part of lecture in one sitting. So because there's still a bit to cover. So maybe we take let's say 6 minutes break. We come back let's say around 9 or 2. Is that okay? Yeah. We take a break now and then we'll finish the last part of the lecture in one sitting. Okay. If you do have any questions, feel free to put them in the group chat. Welcome back. We see some questions. For last slide, why all PI added with additional one? Oh, that's right. Actually, why? Let me see. Initial investment. Oh, yeah, you're right. NPV. I think, yeah, it's a typo. You're right. There's an additional one. It shouldn't be there. You're right. It's a typo. So so this should be 0.33. This is 0.3, 0.33, and 0.48. Thanks for pointing that out. Okay. Yeah, thanks for that. Okay, so far we have been talking about decision methods, right? PI, MPV, IRR. Now, the question is, an earlier classmate of yours asked, okay, so what happens if something change and the cash flow change, right? Obviously, it affect our decision at the end. So now the question is, can we actually come up with the cash flows, right? So that we can use this cash flow to use the decision rules such as MPV or IRR. So now what we're going to cover is how do we determine the cash flows, the numbers, right? In the first part of the lecture, we have always been talking about, oh, the question will give you the cash flow, but now we need to come up with the cash flow. And the question we need to ask ourselves is, what cash flow amount should we include? And so there are some relevant cash flows that we include. Number one, sunk cost. Now, sunk cost is cost that has been incurred in the past, and this cost should not be included in the relevant cash flows for your project. Okay, example that we can see here: a firm wants to reevaluate a project. The project already cost 50K. A further investment of 40K is required, and the present value of the future cash flow is 60K. Question: should the firm continue with this project? Yes or no? Yes. Okay. Yeah, right. Yes. And let me explain to you why, in case for those who are not so familiar. Can you see that already cost, this is the sunk cost, right? So this cost should not be relevant for you to determine whether you should invest in the project or not. So the only relevant cost that you should take into account is this 40K that you have to on, that you have to invest in, right? At the end of the day, the project is going to use 60K, means that you're still going to earn additional 20K. So you should take on this project. Okay, so I hope you can see 50K is a sunk cost. So sunk cost actually, this is I put 2 stars here or 3 stars because sunk cost is a course that is very tricky. So whenever you read questions, right, whether it's an assignment, your GBA, please read very carefully. Your final exam, make sure you think whether is it a sunk cost or is it not sunk cost. Okay, we have one more example later. Now, opportunity cost. So cost involved in the loss of the option. So a firm owns a land. The firm either use the land for a project or sells the land for 100K. Suppose the NPV of the project is 80K. Should the firm accept this project? Yes or no? Should it accept? No, you can see because you can actually sell the land for 100K and the project will give you 80K. So what is why and no? So some cost no and means do not include. Opportunity cost means that you must include in terms of the cash flows. Site erosion cost. So this is quite intuitive. Example is a new project generates a cash flow of 10 million a year. However, introduction of this new product will reduce the cash flow of existing project by 4 million. So what is the cash flow that we should use in evaluating this new project? Who can see that is 10 minus 6, sorry, not 6, minus 4 equals to 6 million, because there is an erosion cost that's going to happen here. So this must be included. Net working capital. So net working capital is your CA minus CL. So net working capital must be included in your cash flow, relevant cash flow. Tax effect must be included, and financing costs do not include financing costs in your relevant cash flows. Okay. We'll see the examples in the following slides. So at the end of the day, right, the concept is we are only concerned with cash flows that are incremental to the project. It means that it increases the cash product because of the project, right? So if the cost such as sunk cost is not affected by this project, right? It's not incremental cost. It's very sunk. It should not be included in the decision making whether you should accept or reject the project. So that is the bottom line, right? Where is it incremental cash flow? Okay, we have an example here. So let's look at this example. It spends 250K to work on a preliminary version of the car. It spends another 150K to perform some market testing analysis. Which of these costs should be included in the project's cash flow? Neither. Very good. You're right. No, yeah. So neither of it. So why? Because it has spent. It's the past tense already, spent already. And it has also spent again in market testing. So can you see that this is so tricky? That's why some course is really tricky. So be very careful for your final exam as well, right? It has both spent in market testing and preliminary work. So it's already in the past, already some. So none should be included. You're right. It also has an empty warehouse which can store new lines of sports car. Should the cost of the warehouse be included in the MPV? Yes, that's right. You can see the opportunity cost here. Okay. Yeah, of course. The firm is currently producing an existing line of compact cars. Some of the potential customers for this sports car will come from the customer base for its compact car. Do we need to take into account when we calculate MPV of a new sports car? Yes, so this is your erosion or indirect cost. That's right. So it's not too it's quite easy to see. Okay, we have one more example. Suppose this company is setting up a new manufacturing plant in South Park. The company bought some land 6 years ago for 7.5 million in anticipation of using it as a warehouse and distribution site. But the company has decided to rent this facility elsewhere. So first question, should this cost be included? No, yes, that's right, not included because it's sunk cost. You already purchased it some 6 years ago, sunk cost already. Okay. Yeah, the land would net 10.3 million if you're sold today. So should this cost be included? This 10.3 million? Yes, because it's an opportunity cost. That's right. The company wants to build its new manufacturing plant on this land. The plant will cost 42 million to build, and the site requires 975K worth of grading. So the question is this 24 million and 795K. Should both of these costs be included in the project? Yes, that's right. Because both of these costs are incremental costs that will be involved. right? So based on this, the answers are actually provided here. The initial cost that we need to include will be either 10.3, 24 million, and 975K. Okay, so this is more about, okay, what cost to include, what cost not to include, right? Now we're going to tap your lecture one knowledge. I hope it's not too long ago because it has been a while. So remember, and now I'm not going to very detail, right? If you kind of forgotten, please refer back to lecture one where we went into details trying to even prove the formulas. We'll not do that now. We already assume that you kind of already understand these equations here. Okay, so we're going to test your lecture one knowledge. I do see a question. Shouldn't the cost of renting a facility elsewhere instead of using the land considered be an opportunity cost? Yeah, it's an opportunity cost. Yes, that's right. Opportunity cost here. So it should be included. Yeah. So that's why it's being included in your cash flow calculations. Ah, okay. The renter of this facility has decided to rent this facility elsewhere. No. So why is this cost not included? Because this cost is not related to the project, right? So regardless of whether you take on this project or not, you are going to incur this rental cost 6 years ago, which you have decided, sorry, you kind of decided to incur this rental cost 6 years ago for the warehouse and distribution, right? So it's not going, your project, whether you take on this project or not, it's not going to affect this cost, this rental cost that you're going to incur. Can you see that? Yeah. So you could, but remember, the company decided not to, right? So already decided not to do the warehouse and distribution side on the land itself. That's the thing. And remember what is the one that you're considering? You're considering the cost of this land, of the sales of the land, right? That is your opportunity cost, the sales of this land. Yeah, because there's a sales of the land. So that is the opportunity cost. So if you're going to consider the distribution side cost, then and the sales, remember land only can use one. Either use the distribution side or you sell it, right? But in this question, we're going to consider sales instead. That's a good question. Thanks for asking that. Okay. All right. So moving back to your CFA. So your CFA is a cash flow from assets. Okay, so given the interest of time as well, I'll not go through this formula because we have actually went through in detail in lecture one. So if you need a recap, I really encourage you to watch lecture one again because we need the proofs of the formula, right? As a quick just a recap, we know that for a cash flow from asset, they consist of three parts, right? We have operating cash flow, we have what we spend in terms of fixed asset, which is the net capital spent, and last but not least, we have this negative change in net working capital. And in lecture one, we kind of emphasize it's a negative change. We are not looking at just the change, and we're not looking at net working capital. We are looking at change in net working capital. Okay, and we have really kind of like really a lot of detail in lecture one. So I really encourage you to look through this if you forget about it, right? And this slide is actually just I just replicated lecture one slide. Now, but what's interesting now is that we are going to use this formula here to determine or to use this formula to come out with the cash flows that we're going to use to predict the project's cash flow in order to determine whether we should accept or reject the project. Okay, so in terms of, we are going to focus first on the net capital spent. Okay, so net capital spent is how much you spend in fixed assets, right? And recall that the idea is that initially we will have some cost relating to fixed asset, right? We incur some cost related to fixed asset. Now, let's say at the end of the project, we might want to sell the fixed asset, right? We can sell off the fixed asset. And so this sales of fixed asset, we're going to get some money back, right? We're going to get some positive cash flow into our pocket. So this cost must be included. And this is called the salvage value. So the salvage value is the estimated value of the asset at the end of its useful life. Now, the salvage value, it can be different from the book value. Okay, book value is an accounting concept. So I like to use this example in layman terms, very simple. Imagine you have an iPhone. You bought an iPhone. Now there's iPhone 16 out, right? So you have an iPhone 13, let's say. We know that, let's say for iPhone, if you are like an accountant, right? You're going to depreciate your iPhone for 2 years. And let's say after 2 years, because of depreciation, your iPhone has zero book value. It's on accounting terms is zero, no more value. You have depreciated for 2 years, no more value. Now, but you know in real life, if you're going to sell this iPhone 13 on Carousel, you can still get some money, right? Maybe you can get 400, 500. I don't know how much you get, but 500, let's say. This 400 that you can get from selling the iPhone 13 on Carousel is your salvage value. It's what you can salvage from your iPhone 13. Can you see that? But let's say in your accountant, you have already depreciated the iPhone for 2 years and has zero book value. So in this sense, the book value and salvage value are totally different things. I want to highlight to you that salvage value is the value of the asset that you get when you sell the asset in the market, like in Carousel. Your book value or residual value is your accounting concept of taking the cost minus the accumulated depreciation, right? So how much you're going to depreciate. So for iPhone case, you're going to depreciate 50% of the value in year one, 50% in year two, and after 2 years, your iPhone has zero book value, it has zero residual value, but it can still have salvage value because you can still sell your iPhone 13 in the market for some money. Now, we know that we need to consider tax, right? We need to consider some tax implications. So yes, okay, you sell your iPhone in the market. Now, let's say if the salvage value is more than the book value, it means the company is going to earn a profit on the sales of asset, right? You're going to earn a profit from your sales. It means that the company will have to pay tax on this profit. And so let's say the after-tax salvage is the salvage value minus the tax rate times the difference in salvage and book value. So your difference in salvage and book value, let's say, is a profit. You will have to pay taxes on the profit. You have to pay tax on the profit. So your after-tax salvage value that you're going to get will be less than your pure salvage value that you have sold in the market because of paying taxes. So the net effect is your net cash flow is less than the salvage value because you have just paid some taxes on your profit that you have made, simply because your salvage value is more than your book value. Any question? This is very important. This concept of salvage value and after-tax salvage value is very important. Okay. Now, then the second part of the question is, if your salvage value is less than the book value, means what? It means that the company is making a loss from the sales of asset because your salvage is less than the book. The actual book value is more. And so it means that you're going to receive a tax rebate on this loss. And the net cash flow, in the case where your salvage value is less than book value, will be more than your salvage value. We'll see two examples in just a bit, and you'll see the difference. Okay, so just keep in mind that if your salvage is more than book value, you're going to make a loss. Sorry, you're going to make a profit. When your salvage is more than book, you're going to make a profit. So you have to pay tax. If your salvage is less than book value, it means that you're going to make a loss on the sales, and so you're going to get a rebate. The government is going to give you money. So let's look at this example here, and we'll illustrate this point here. Suppose you have a project, invest 1000K in equipment. The project lasts 5 years. At the end of the 5 years, the equipment can be sold for 500K. The book value of the equipment is 300K. The tax rate is 40%. What are the flows? So let's start off with what we know, right? So initially, we have to invest 1000K, right? 1000, let's put 1000 here. At the end of 5 years, we can sell the equipment for 500K. So we know that if we say we can sell, it means that, remember the iPhone example, we're going to sell in the market. It means our salvage value is 500K. Now, what's our book value? At the end of the 5 years, our book value is 300K. So where is 300K? The question is, what is our after-tax salvage? So after-tax salvage, based on the formula, is your salvage value minus your tax of 40% multiplied by 500 minus 300, right? Your 40% tax minus your profit that you have made from the selling the equipment for 500K, where your book value is 300K. And so this will give you 420K. Can you see that your 420 here is less than your salvage that you have made? So let's say you sell your equipment in Carousel, you're going to earn, you're actually supposed to earn 500, but now you have to pay $80 to the government because of the profit you have made. And so at year 5, the amount of cash flow that comes in would be 420. It's not 500 because you have to consider the tax implication of your salvage. Pause for a short while. Do we have any questions for this? Okay. If not, I'll move on. Now, the question continues. What if you can only sell the equipment for 200K? So what does it mean? So your salvage is 200 now. Your book value is still going to be the same, right? Your book value is 300. So what's your after-tax salvage? After-tax salvage is your salvage value, 200 minus 40% times 200 minus 300, right? 300 is your book value. And this will give you 240. And so at the end of the year 5, you're going to get 240 of cash inflow. Can you see that this 240 is more than your initial sales of selling equipment at 200, because now you're getting $40 of tax rebate because you're going to sell the asset at a loss. Okay, now we're going to continue on discussing more on this net capital spend. This is a bit more of an accounting concept. We know that whenever we depreciate, we normally use straight line depreciation. We take the initial cost, divide minus the any book value or residual value, divide by number of years, right? Then that's the depreciation expenses that you have to charge per year. So just a comment here, note that residual value is different from salvage value. And we have already emphasized this earlier, that salvage value is what you sell in the carousel, in the example of the iPhone, and your residual value is what you record in your accounting books. So we have an interesting example here. Suppose the asset costs 6350. The depreciation straight line to zero. So your at the end of the 8 years, it's going to be a zero. The asset is going to be used for 5 years, and at the end of the project, the asset can be sold for 1250. So this is your salvage value. Now, what's your depreciation? Relevant tax is this. What is the after-tax cash flow, which is the after-tax salvage value, right? So what's our depreciation? Depreciation expenses is 635,000 divided by 8 years, right? And that is 79375, right? So this is our depreciation expense that we are going to incur. Now, the question was after tax salvage, right? So what's our salvage value? Our salvage value is 125,000 minus the tax rate of 35%. And then we know that the salvage is 125,000 minus the book value. We see that the project is used for only 5 years. So our book value is 79375 times 3, right? So why times 3? Because you have used it for 5 years, means that whatever that's left after using the 5 years is you left 3 years left, right? 3 years left. And these 3 years that's left is your book value left. Any questions? So in this case, we are going to get a tax rebate. The answer is here already, so you're going to get a tax rebate. We have one more example because this net capital spend is very important. So we have another example here. Suppose you purchase equipment for 100K, it costs 10K to have it delivered and installed. Based on your past information, you believe that you can sell the asset for 17K when it's done in 6 years. The marginal tax rate is 40%. What is the depreciation each year after tax cash flow in 6 years? Suppose appropriate depreciation schedule is a straight line and we depreciate the equipment to 17K in 6 years. So what does this mean? Let's try to dissect the information here. It means what? It means this is your book value at 6 years, right? A year 6. Okay, so our depreciation expense is what? So what's our cost of the equipment? First question, what is our cost of equipment here? Oh, okay, there's a trick on this question. Yes, it's 110K. Yes, so please, again, I don't know. I realize the school likes, especially for assessment, your final exam, they always like this to do this kind of small little twist in the question. So I really encourage you to be very careful when you do your final exam. Do not be I mean it's still stressful, but do not be too anxious, right? Read the question carefully. In this case, yes, you're right, it says 110K. So depreciation is I'm just going to write depreciation here, DEPRE. So it's 110,000. Your peak value at the end of 6 years is plus minus 117,000, right? Because that's at the end of the year, you still have some money left, so value left. And this divided by 6 will give you your depreciation expenses. Your depreciation expenses in this case is, I'm just going to write it here, 155 15500. Okay, this is your depreciation expense, 15500. Okay, so your book value in year 6 is as given in the question 17000. Now the question is what's the after tax salvage? So they say that you can sell the equipment for 17K. So this is your salvage value. So the salvage value is 17000 minus the tax rate of 40%. Now, in this case, so happen your salvage value is 17K minus your book value is also 17K. So it means that there is actually no effect of taxes on your salvage value because your book value, in this case, your book value here, given this part, and your salvage value here is so happen the same such that this gives you 0. Okay. So this is quite clear. Is when your salvage value and book value is the same, there's no tax effect because there's no profit, there's no loss. Okay, so that's all we're going to talk about net capital spend. Now we're going to move on to the second part of the CFF, sorry, the third part of your CFFA formula, which is your net change in net working capital. As a small recap, we are in terms of our project, we are looking at the change in working capital, not the level of working capital. So we need to consider the change. All right. Whenever there's a positive increase in net working capital, it means that there is more cash required, right? Remember, we know that working capital is capital or money required in the daily operations, right? Whenever we need more money, means there is a negative cash flow, right? It needs more money. Now, if we need less money, it's a positive cash flow, right? So if you think it this way, it can't make sense. Okay, and if you totally forget what's working capital, I really encourage you to review lecture 1 again. Now let's look at this example here. Okay, calculate the cash flow for investment in working capital in the following example. The cash flow from investment in net working capital for year T is negative change in net working capital for year T. Okay, so we are given here the total net working capital for year 0 is 10. Year 1 is 30, year 2 is 25, year 3 you don't need any more working capital. Okay, so what is the change that's happening here? So for year 0, there's a positive change of 10, right? Because it requires 10. Now, in year 1, there is a positive change of 20. Year 2, there's negative change of 5. And year 3, there's a negative change of 25, right? We are talking about change. But remember for your CFFA formula, we are looking at the negative change. So we are going to put the negative, multiply negative in all these values here. So we're going to reverse the sign. And the last thing I want you to take note is the aggregate of this must be equals to 0. So, okay, I repeat again. Aggregate of this must be 0. This is by definition, very important. So you need to make sure that equals to 0. And in this case, it equals to 0. If it's not 0, means that you need to do something to make it 0. We will see an example in a bit, right? You must do something to make it to 0. And in simple terms, let's try to understand why must it be equal to 0? Why this person saying must be equal to 0? Do we just memorize? No. Let's think about it in simple terms, right? Let's say we have a project. We initially need some net working capital, right? Capital to run the business daily. Now, we need some capital to run the business. Let's say at the end of the project, the project finished in year 3. Whatever capital that we need to run the business can be released back to the business, right? So when it's being released back to the business, net, right, it must be zero, right? Think about it, it must be zero. It can't be when the project ends, you still need working capital. It can't be, right? And when the project ends, you shouldn't need any more working capital relating to the project. So this is very important. I'm going to start. Okay, so that's for negative change in net working capital. For operating cash flow, we have talked about this bottom-up approach, top-down approach in lecture one. So I will not really go through. But what I want to emphasize, because lecture one we did not really emphasize on this, is the tax shield method, right? So this tax shield method is that the idea is that the depreciation, okay, normally we don't really consider interest now. That's why it's highlighted blue. So I'm just going to cancel this. But the depreciation will provide a shielding effect to the operating cash flow. Okay, so this is very important. Okay, and in the past few semesters, right, especially your finals, usually when you get to ensures, you are like, oh, what? How do you calculate operating cash flow? You just take sales minus the cost. That is not operating cash flow. Please take note that operating cash flow is sales minus the for the tax shield method is sales minus the cost plus back the depreciation. And I want to highlight here, why do we plus back depreciation? Because depreciation is a non-cash. And I really encourage you to look through lecture one again. I went into detail, right? Because non-cash is not a cash flow. You need to add the depreciation expense back. That's why we add depreciation. And depreciation also, because we add it back, there's a tax still effect, right? That's why you need to add back depreciation times tax. And so please be very careful. Operating cash flow is not sales minus cost. That's not operating cash flow. That's gross profit. In lecture one, we talk about this, right? Gross profit. Now, operating cash flow is your sales minus the cost multiplied by tax, one minus tax. Then you add back the depreciation because of the tax shielding effect. And because depreciation is a non-cash item. Okay. Of course, you can use the top-down approach or bottom-up approach as well, right? But most of the time, you will use the tax shield method. So let's look at this example here. Suppose a project generates 1,000. The cash expense is 600. Depreciation charge is 200. Tax rate is 35. So what's the operating cash flow? Operating cash flow is 1,000 minus 600. 1 minus 35%. You must plus back your depreciation tax shield of 200 times tax rate of 35%. Okay, again, I'm going to repeat it one more time because I think I saw a few, the last few semester where you calculate operating cash flow. Operating cash flow is not revenue minus expense. That is not operating cash flow. That is your gross profit. Operating cash flow, you need to you need to do this. Basically, you need to do this, you need to do this, right? This is operating cash flow. So please be very clear. What operating cash flow is gross profit. Okay. We have one more example here to have a look. Consider a 3-year expansion project. Initial investment is 1860K. Fixed asset will be straight line depreciated to zero over the 3 years life until it's worthless. So it's not going to worth anything. The project is estimated to generate 1950K in annual sales with a cost of 1060K. What is the operating cash flow for this project? Okay, so first thing, because we're not given depreciation, let's calculate depreciation, right? So depreciation is given by the initial investment 1860 divided by 3 years, right? We're going to depreciate 3 years to 0. 3 years to 0. This gives 620,123. Right? The operating cash flow is given by operating cash flow using the tax shield method is given by 1950, 123 is your sales generated minus the cost of 1060K, multiply by 1 minus 35%, right? Your tax amount, plus your depreciation, right? 620K multiplied by the depreciation, your tax rate of 35%. And this should give you your answer here, right? So this is your tax shield method where your depreciation is filling your operating cash flows. A small pause here. Any questions? Okay. Now let's take a summary here. Okay, we have covered the three components of CFFA, right? We have the operating cash flow, we have just talked about it. We have talked about the NCS, which is net capital spend, and that was quite in detail. And last but not least, we have talked about the change in net working capital. Okay. So having the three components, we can now create our cash flows. Taking into account the important stuff like initial investment, we need to think about the salvage value. Please don't forget this. In sometimes your final assessment, your final exam, maybe because it's a bit too anxious, you can't just forget about this tax after tax effect and all those things, right? Please do not forget. I really encourage you to refer to this slide whenever you do such a question in your final exam. Please take into account the change in net working capital. And don't forget the recovery. Recovery meaning your aggregate must be equal to 0. We have one example that I'd like to show you later. And last but not least, calculate the cash flow from operations. And this is not equals to gross profit. So, if you are panicking, please do not put gross profit. Please do not put revenue minus expense equals operating cash flow. That is gross profit. It's not operating cash flow. Okay. So we have this example here called Sharp project. I'll not be going through this. Please go through it yourself, but because the answers are provided. Okay, so please go through yourself when you revise. And this discussion question, answers are provided as well, so I'll not go through it. I want to go through this example here, which has no answers provided. Okay, so this is an important one. And this example will really encompass all that you have learned about the three components: operating cash flow, net capital spend, and change in net working capital. Okay, so let's look at this example here in detail. Suppose you have this new sausage machine that you want to install with a cost, the installation cost is 735K. This cost will be depreciated straight line to 0, okay, it's important, over the project 5 years period, at the end of which the sausage machine will have a scrap of 105K. So this is your salvage value. But we need to compare after tax salvage. This is just the salvage. Okay. The sausage machine will save the firm 240K per year in pre-tax operating costs. The system requires an initial investment in net working capital of 35K. Whenever a net working capital, please recall recovery. So we need to ensure there's a recovery that's going to take place, meaning that the aggregate net working capital spend or aggregate change in net working capital spend is 0. And the tax rate is 4%, discount rate is 8%. What is the NPV of the project? So now can you see that in this question, we need to formulate the cash flows and we need to do NPV, which is what we covered in the first part of our lecture. And so I hope, right, now you can appreciate the importance of calculating your cash flow correctly. Imagine you calculated your cash flow wrongly. Your NPV decision might be wrong and it's going to trickle down to all your subparts. And in your final exam, as much as the marker might give you method marks. There's going to be marks given for decisions. Decision making, meaning, are you going to accept the project? Why are you going to accept the project? Because positive NPV. In a situation where your NPV gives you a wrong decision, you are not going to get method marks. So please be very careful. Please spend a bit more time on the cash flow before jumping to just calculating NPV. Okay. Now, let's look at what we should do. Okay, depreciation. So we know depreciation straight line and till 0 for 5 years. So we know that the cost of the equipment is 735,000 divided by 5 years. Our depreciation cost is 147,000. This one is a bit direct because there's no book value at the end. It's just depreciation till 0. Now, what's the after-tax salvage? We know that we can sell our equipment in the 5th year for 105,000 minus the 34%. And then we going to sell it for an after-tax salvage. Sorry, a salvage of 105K minus the 0 book value. And so this would give us a value of, let me just zoom in a little here. Zoom in a little. This will give us an after-tax salvage of 693,000. So this is our after-tax salvage, right? It makes sense because what we get at the end of the day is less than 105K, right? Because we need to pay tax on the profit of the salvage, right? So that's why at the end we only get 693K. Okay. In terms of operating cash flow, so what's our operating cash flow now? We know that, okay, I'm just going to flip back so that to show you how much you're going to save. So this one is saving, right? So this saving is as if it's like a revenue to you. You're saving money. Okay, so we're going to save 204K. So this saving amount is what we're going to use in terms of our operating cash flow. So it's 204K multiplied by 1 minus the 4% because this saving is like your revenue to you. Now you need to add back, remember, you are using a tax shielding method. We need to add back the depreciation amount of 147,000 times the depreciation plus the tax of 34%. And this will give us 184,620. So this is our operating cash flow using the tax shield method. Yeah, right. uh, yeah, right. There's one extra 0 here. Yeah, right. So after tax salvage should be 69300. There's extra 0. Thanks for pointing that out. Okay. All right. So our operating cash flow. So our first operating cash flow is coming in year 1 to year 4, right? So year 1 to year 4, actually year 5 as well, right? We know that this is for 5 years, so we're going to get operating cash flow positive of 184,620. 184,620. So this one's a shortcut. Put year 1 to year 4. So in your Excel, you have to put 186,420 for year 1, 186,420 to 184,620 for year 2, 184,620 for year 3, blah blah blah. You have every year, right? Then you use the NPV method. You cannot just put 1 year like this. So just be very careful. please put properly. Okay. Okay, so year zero, we know that the question says we have to invest in the net working capital. So this is okay. So I'm just going to flip that out. There's an initial investment of this, right? So in year zero, the change in net working capital is positive 35K, right? The change. Now, but then we know we need negative change. So the negative change is negative 350. Okay. I repeat again. The question says that you need to invest in net working capital of 35K, right? Now, 35K is a positive change, right? The change in net working capital is positive 35K. But we always need to consider the negative change. So our negative change is negative 35K. No. In year after that, there is no more change, right? After that, the net working capital is 35K, so there's no more change. But in year five, there's going to be a drop to 35K. The negative change in net working capital will be 35K. And the question you ask me is, wait. Where in the question they say that at the end of the year there is going to be a negative change in net working capital, negative change in net working capital of 35K. The thing is the question will not tell you. That's the trick of the question. Because you need to remember what I mentioned way back here and I wrote it really big that your change must be zero. So what does this mean? It means that at the end of the project in year five, for whatever question, they will not mention it, you need to ensure that your total here, the total for this is zero. And so if it's not zero, we must make it zero here. That's why we put a positive 35K in year five, make it zero. So total becomes zero. Okay. Next, the stand. So the question says that we initially have an installation cost of 735,000. And then in year five, we have a after-tax salvage of 69300. So sorry, there's a negative here because at the start we need to spend money to buy the equipment. So negative 735,000. Now I'm going to use a different color. So at the end of the day, what is our CFA? We just add up all the figures here, add this up, right? So what's the figures? I'm just going to write it below here. Is negative 770,000. This is going to be 184620, and this is going to be 288920. Okay, and if you do in your Excel, you do an MPV of all these cash flows here, your answer will be 38119. This will be your MPV. So question at the end of the day, you usually ask, should you accept or reject this project? What's the answer? Yes, right, because it's a positive. Right, accept it. Okay, so I really encourage you to do this question and give it a try in person in your Excel, because doing it once really makes a difference compared to someone explaining it to you, right? Cannot emphasize more than you should try it once. So I know it's about time, but let's just cover this small little part at the end of the lecture. It's just a very short one, right? And the thing is, um, so there's these two parts here called scenario analysis and sensitivity analysis, and it's a very light one. So it's not very complicated, right? Okay, let's think about scenario analysis. Let's think about the idea first, right? The whole idea of a scenario analysis is this: we want to map out different scenarios, a bad scenario, a good scenario, and a more moderate scenario. And we want to see, based on this scenario, what is, let's say, the CFA, what is the profit, right? And so the idea of scenario analysis, this is just an example here. We have the base case, you have the lower case and upper case, right? Different scenario. And then we have different, like let's say, units sold, right? Different amount of units sold. And then the idea is that based on the different scenarios, we want to see what is our MPV, right? And what's our IRR. And so if we have this different scenario, we can determine the probability of the scenario happening. And based on this probability, we can determine the aggregate or the total MPV. Okay, so we have an example to show you here. So suppose we have Nike, they just introduced a new winter running clothes. After much scenario analysis, we know that the project MPV would be 34 million at discount rate of 10%. Okay, this is more like the base case, right? Uh, and the thing is, there's some worst case scenario where the MPV is of this new product would be negative 190 million, or the best case scenario, it will give you 150 million, right? And so based on this, we have a different probability, right? We have a, let's look at the next one. We have probability of the worst case is 10%, the base case is 65, and best case 25. So based on the various MPVs, we can multiply the probability to the worst case MPV, the probability of the base case probability to the base case MPV, the best case probability to the best case MPV, and you can even get aggregated MPV of our project. And if it's positive, then we should still accept the project, right? So what is it trying to say here? So scenario analysis try to give you the various scenario, and hopefully by aggregating the various scenario, by including the probability of this scenario happening, if the aggregated MPV is still positive, we should accept the project. That's what scenario analysis is trying to do, right? Different scenarios happening, and then determining whether we should accept or reject the project. Of course, the issue with scenario analysis is it assumes that all the bad things, all the good things happen in one scenario, right? But in most cases, it doesn't work this way. Like sometimes there's a positive thing for one item but negative for the other, right? So might not be very accurate. It doesn't happen that way. All positive happens together, all negative happens together. And sometimes focus on standalone and it can be quite subjective, right? How do you know the percentage or probability of a positive case is 25%? You do not know, right? It's very subjective to say that it's 25%. All right. the last thing we talk about for today, I know it's a lot of information, just hang in there. One last thing, very light also, is sensitivity analysis. So the whole concept of sensitivity analysis, we'll not go in detail, but just a very light version, is that we want to see how one variable affect the output, right? So we want to just change one variable, not all, just one, right? So let's see how does this particular variable, how sensitive this particular variable is that affects the MPV. So it's almost like a what if analysis, right? What if we change our price of the product that we sell by 20 cents? Does it really affect the MPV, right? It's a what if analysis that we need to do. Okay, so the sensitivity analysis here is the unit sales. So what we are changing here is the number of units that we sell, right? So how does this affect our NPV at the end? Right? So the thing that we're changing is units sold. In the next example, we are going to change the fixed cost. So if I change the fixed cost that I incur every year, how does this affect my NPV at the end? Okay. So of course, we need to know a bit on the strengths and pros and weaknesses of the sensitivity analysis. It helps the strengths helps to identify variables that is very sensitive. At the same time, the weaknesses is that sometimes the main thing is that it ignores relationship between variables, right? If I reduce the units sold, wouldn't that reduce cost as well? Because I sell less, maybe it costs less to sell. So it ignores like relationship, right? Does not reflect some diversification that we talked about previously. Okay. So that's all I have for you. There's just some more comments. Does not provide any decision making. It's just analysis, sensitivity analysis, and scenario analysis. In all diversification, it only measures standalone risk, right? So that's all I have. I know maybe you are like breathless as me because I know this last lecture, not last, second last lecture can be very heavy, right? I know it's past the time as well, so don't want to really keep you too long. At the same time, it's heavy, so I really encourage you to watch the recording. Let me just pause the recording now. So